Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Today I want to welcome you to another Subscriber Request Tuesday video. And I think what's really important about these videos, these are companies that subscribers have asked me to cover. They're not necessarily my choices or companies that I found myself. Now, what's interesting about that is sometimes subscribers ask me to cover companies that I would never even consider investing in. Sometimes they give me some really great ideas, and of course everything in between. So they're actually kind of fun for me because often I find myself looking at stocks that I haven't otherwise been examining or looking at, and I actually have several in today's video. Today's video, I'm going to actually do it as I've been doing these to try to cover as many as I possibly can. You know, for the subscribers who have actually requested me to cover stocks, I'm going to be looking at the communication services sector today, and there's several subsectors or sub-industry groups within that sector. I'm actually be looking at 5 companies. So let's go ahead and get started and start by looking at the FastGraphs portfolio review here and look at what I'm going to be covering. I'm going to be covering 3 companies that are actually headquartered in China or Chinese-based company. And I don't know if I'm pronouncing these correctly. I kind of chuckled to myself a little because I got one subscriber or one viewer got pretty upset because I mispronounced, the home builder D.R. Horton. And, frankly, I don't know what the name is. Is it Dr. Horton? DHI is the symbol, so I often call it D.H. Horton. But the point is, the name of the company is not really that important to me. What the company does, what the business produces, those are the things that really matter to me. So anyway, I apologize in advance if I'm mispronouncing these names. So we've got DouYu International, DouYu possibly is how you might pronounce that, Huya. And these companies are related. I was actually asked about Huya, but Huya and DouYu are actually in a discussions for a merger right now, and they're running into some resistance from the Chinese government. So that's something, when you look at these companies more carefully, if you decide to, you want to research more thoroughly. And then Nexstar, which is the largest television company in the country, they own more television stations than anybody. And then Tencent Holdings, which actually has an interest in Huya and DouYu. So, all 3 of these companies are related to an extent, and I'm going to talk more about those in a moment. And then finally, I've had one very persistent subscriber, I apologize in advance, who kept asking me to cover World Wrestling Entertainment. And this is actually an interesting one for me because one of the things it does, it really allows me to, I think, illustrate how to effectively utilize FastGraphs when you're analyzing stocks. So I look forward to getting to that one. So let's go ahead and start looking at these companies individually from the perspective of the FastGraphs Fundamentals Analyzer software tool. And the first one I'm going to look at is Huya. And again, it's a Chinese-based company. I'll let you guys do your own research. But the problem with a stock like this, as you can see, it's only been public for a short while, since May of 2018. It is an ADR. I think it's actually listed on the Hong Kong exchange, but I'm not sure. Again, these next 3 companies are not companies that I know a great deal about. Part of it might have to do with my demographic, if you will, and that's a fancy way of saying how old I am. But the reality of it is, if you look at what this company does, it's a gaming company, I guess I'm going to call it. They're involved in these games, and they've got, broadcasts and live broadcasts, and they have videos on games and matches. So it's a way for people, let me try to get out of here. It's a way for people to interact and play, I guess, especially in the Asian markets, China, I think, predominantly. But anyway, that's Huya. Now, here's what's interesting. And when you're looking at a tool like FastGraphs, I want you to understand, and I'm going to repeat this several times during this video, this is a tool to think with. It's an analytical tool. It draws a picture. Like, for example, right now I'm looking at an adjusted earnings growth rate, and I'm not getting a meaningful number. So it says NMF. That stands for no meaningful number, because I've got weird numbers here. I've got a minus 15% growth, on the first year. I'm not even sure how that's calculated. Then I've got 100% growth in 2019, then followed by another almost 100% growth, then minus 7% growth, and then 81% growth expected this year and 39% next year. So I'm drawing this as a 15 PE. That probably it doesn't relate based on that level of growth. Now, the normal PE has been about 48. But I want to talk about this because people ask me this question all the time. These are valuation reference lines. There's something for you to analyze. So what you've got here is a PE multiple of 48.51 drawn, if you will, between the stock prices. Now you can see there's no meaningful numbers here because there was losses. And then you start getting getting, some crazy PE ratios up here. PE's a 60. You've got a PE down here of 38. So we've got this 48 being drawn in there. You analyze it. You say, okay, since the company's had earnings. Now let's start shortening the graph here a little bit and see if we can start honing in on a growth rate. I still don't do it with 5 years because I still have this one negative year. So I'm going to drop this to 4 years. Now this includes forecasting data. All right, so I'm only looking at 1 year of history and then 3 years of forecast. But now I'm getting a growth rate based on these numbers here, down here at the bottom of the graph, equaling about 46%. Since that's high growth, I'm using PE ratio equal to growth rate. And that would indicate that for the last, year and 4 months or so, this company's been trading at a valuation that probably makes economic sense given the fast and high growth. When I'm using Peter Lynch's PE equals growth rate formula here. So this orange line is a PE of 46, and then the blue line is 48.51. That's really the same number, okay? It just mathematically comes out a little bit different. But this would indicate that there would be an awful lot of potential to own this stock, if you were willing to apply a 48 PE to it, okay? But this is looking at history and looking at only the 1 year of real history and then some forecast data that we have here. Now, things change a little bit when I go into the forecasting calculator because now I'm getting an earnings growth rate expectation of 17%, which is a combination of all these numbers. So now I'm using a PE of 17 here. But if I put this into the normal multiple, now I'm back to that 46, 48. And I've got, I can pick, multiples that have been. Now, the lowest multiple would be 35 times earnings, which might be the most realistic of this group. So I might apply that here and say, okay, this company has a lot of potential for growth and a lot of potential to generate very substantial rates of return, assuming all this stuff comes to pass and all of it is true. Now, one problem I have with that is when I look at the analyst scorecard, which is very, very short here, so I'm not going to spend a lot of time. Analysts never have gotten this company right. So, but that's not really fair because it's only been, one data point. We're really talking about, what happened in 2020. If I go back to this scorecard and look at it from the 1 year, forecast going out, I want you to notice that what they missed was 2019 and 2020, which obviously are COVID years. So, it's hard to even factor that in for any company, but one this young, I really find it very, very difficult. Now, as I mentioned, moving on, so, there's a possibility this could be a very, strong growth stock. Now, I do want to look at one other thing here. When I go into forecasting and look at 3 to 5 year growth, I've only got one analyst forecasting 45.8% long-term growth for this company. That would make it look extremely cheap if it's able to grow this fast. That's all due to the power of compounding. But if I go into other sites like Yahoo Finance, for example, and this is the problem with young companies, and I get down here and I look at, next year's growth is expected to be 68.7%, but the next 5 years, the analysts reporting to Reuters here are only expecting 6.5% growth. Well, that's a long ways off. So if I go to my custom calculator here and I put, 6.5% growth in, and draw this graph with a 6.5% growth, the picture changes dramatically. The point is, at some level here with, very scant historical data to go by, trying to understand this company, you have to basically come up with a way to create your own forecasts. And then you could possibly go to the custom tool here and input your own data. You could input your own growth rates. You could put in your own earnings, dividends, if any, which is probably aren't going to be paid. But this is tricky when you're dealing with a stock that's this young and has this kind of numbers. Now, as I move on and I go to the company that they're looking at merging with, DoYu, and I'm possibly pronouncing that incorrectly. Apologize in advance, Larry Melman. But anyway, if I look at forecasting graphs here, we've got, again, some pretty crazy forecasts. We're seeing these numbers here that aren't really meaningful numbers because, when you go from a negative 4 cents to a positive 37 cents, you get a big number, but it's really kind of, mathematically awkward, if you will. And if I go to Yahoo estimates here and look at what the growth rates might be expected for this company, they say next year is going to be 3,200%. That's that weirdness, but they're saying the next 5 years is going to be 36%. So if I go back here and look at the long-term growth rate, This group getting data from FactSet is saying 260. Well, I'm sure that's a combination of the 3,200% plus the growth that's expected. So you're dealing with some really crazy numbers here. It's hard to say what these guys might be doing. But once again, we've got a relatively young company with only probably not even a total of 2 years worth of history. So again, when I look at the analyst scorecard, I get 100% error on the 1-year forecast, which is all I have a record of because it's only been public that long. And so, it's pretty hard for me to put any credence at all on the analyst estimates at this point. So again, you'd have to go into the company and you'd have to look real deeply into, what the company does and what you think the growth spots are if you feel like this company warrants that kind of additional investigation. I wouldn't invest in them unless I did that, by the way, regardless of what these graphs are showing, especially the forecasting graphs, because as I often say to people, the only thing certain about the future is that it's uncertain. And uncertainty is really a reality of trying to forecast what the future might look like. Now, having said all of that, the next thing you might want to talk about is the other Chinese company, which actually has an interest in both of the stocks that I just covered in terms of, they actually, I think Huya is actually a subsidiary of Tencent. And then, of course, Huya is talking about merging with Douyu, if I'm pronouncing those correctly. And so, you look at Tencent. Now, this is a very interesting company. It's A+ rated with 25% debt. And again, it is a Chinese company. And if you look at this business, if you go into the company's corporate website, it's really a very diverse company. And all of a sudden, my link isn't working. So let me try it again. No, it's for some reason it's currently broken right now. But this company owns, businesses all across the internet for the Chinese and Asian market. Now, from an earnings point of view, operating earnings, you can see there's been this very, very clear and strong correlation. This company's grown earnings at about 36.68%, which obviously is very fast. So I'm drawing these reference lines at around a 36 multiple, 36.68 and 35.71 for the blue line. And you can see that that's really been a pretty good multiple for the stock. Now, going forward, we're looking at 20% plus growth. So if I go to the forecasting calculators, and I'm looking at a 14% average if I add a couple of more years in there. And the bottom line is now this no longer looks, so great. But if I use the normal multiple that this stock has traded at, which has been around 36 or so, and again, I can use the drop down and 35 times earnings, 30 something times earnings, let's put it that way, has been a pretty good multiple. This stock looks like it has a very, very promising future. And the long-term growth rate is expected, there are 5 analysts following this stock, expected to be about 25%. If I check that against other sources, because again, estimates are estimates, they're not actual numbers like you see with the historical data. These guys say only 3.66%, the ones from Reuters. So you get, in addition to everything else that's confusing about these companies, and in addition to the fact that their analyst scorecards have not been that great except for Tencent. Now, they actually have a pretty decent analyst scorecard. The analysts have gotten their numbers right, which tells me also that the company gets good guidance. So this could be a very interesting growth stock. It really all depends on how fast the company's earnings are going to grow in the future. And, you can go to other sources and look up, and try to find additional research and try to study the company better. But this one might actually be worth looking at. But here's the one thing that I do want to point out. Here's the Tencent, and you can see that they have, a lot of different business here. Consumers, enterprises, innovation. These are all the different businesses the company invests in. So, you can see it's a broadly diversified digital content and communication and social communication business. So it's, very interesting. But here's something I really want to point out. This is from Demartirian, and I'm not sure, Aswath, I'm not sure exactly how to pronounce his name. Not really great with pronunciations, guys. But anyway, regardless, he's a renowned value professor, and I respect him a great deal. And he makes something that I want to point out before I go further. When you're investing in China tech stocks, you're also betting on the regulatory attitude, okay? And this is, he's a professor at NYU and a very renowned professor and value investor, I might add. So, the bottom line is, he points out, if you truly get on the wrong side of the government, it can do far more to you than the U.S. government can. So you got to be real careful investing in these China stocks. That's a risk that I think, I want all of you to be aware of when I'm going through these businesses. You know, they have numbers that we've reported. Tencent numbers look really great. The other companies' earnings actually have historically been good. They could be, you know, growing very, very fast in the future. I would say the risk-reward ratio here is probably pretty good, but you do want to take into consideration that you do have regulatory issues here. So let's leave China now and let's move on to the United States. Now, one that, you know, I've been asked many, many times to cover is World Wrestling Entertainment, WWE. I liked this request because, as I said in the beginning of my video today, I get a chance to really show how to utilize a tool like FastGraphs correctly. You know, I've often used the analogy that if you were sitting in my office and I had a surgical scalpel on my desk and you suddenly had an appendicitis attack and you laid down on my desk and said, please, operate on my appendix, well, I'd have a lethal weapon in my hand and you'd be an idiot because there's no way in the world I would know how to take out your appendix. But if I was a skilled surgeon who had done hundreds of surgeries, then, you would be a very fortunate individual and I would be a skilled human being, a skilled surgeon, and I'd have a life-saving device in my hand. So you've got to use tools correctly. You don't try to hammer nails with a saw and you don't try to saw a board with a hammer, proverbially, so to speak. So you want to do the same thing with the tool. You just don't look at this graph and take what you see for face value, because when you study this graph, a couple of things are very interesting. You get some interesting numbers here. You see the normal multiple for this stock has been about 38 times earnings. And this line simply represents a PE of 38. But there are lots of times where that line doesn't touch the prices. So take that in consideration. It certainly never touched the price back here in the early years coming out of the Great Recession. And if I expand this a little further so that you see it, more clearly, this stock, it had very low multiples, PEs. Now, I shouldn't say very low, PEs in the 20s, 23. So this 35 PE, and notice that number changed because this is the dynamic tool. When you're running different growth rates and calculating different time frames, you're going to get different results, guys. And you got to remember that when you're using the tool. That's why we give you the ability to run all these different time frames. And you can even use the scroll bar and go back in time and run historical time frames, where all of a sudden you see here's a period of time from 2001 to 2010 where the company actually had negative growth, and now the normal PE was 24, and we're using the 15 PE fair value. And now this PE actually fit pretty well during that time frame. But as I move forward, now all of a sudden the PE has changed to 59, and it actually works out pretty well. But I want you to notice we've now got a growth rate of about 49.78%. So what I'm doing is I'm evaluating what's been going on. Now, when I look at this stock for the most recent years, where I've got what I would call some good clean data here, I get about a 28% growth rate. That means I'm drawing my orange line at a PE of 27. I'd say that's probably a reasonable valuation for this company over this time frame. And you can see when the PE got up to almost 100 here that we had this, significant drop in price where it came back down to the 27, 28 PE where it belonged, and that would have been about a 60-some% drop in value. So the point is, when you're using this tool, please use it how it was designed. It's designed to help you evaluate. You can learn from the past. Now, this has obviously been a company that's had very, very erratic operating histories. Now, I also had a subscriber say, why don't I look at cash flows more? Well, if I'm going to invest in a stock, I look at every metric I have available. I also go into FundGraphs and I look at the financial statements, the cash flow statements, the income statements, the balance sheet. I look at all kinds of metrics. When I'm doing these videos, I'm just kind of introducing you really to help you decide whether you even want to spend any time looking at these stocks. But I look at cash flows, I get a little better correlation of price, but you can see the huge disconnects where the price to cash flow got ridiculously, absurdly high here before we had this, massive correction. So my point is here, when you're looking at World Wrestling Entertainment, you're looking at a company that's had a very sketchy past, if you will. When I review the analyst scorecard of this particular company, you find that the analysts have been wrong a lot. That's what these red lines are. They've also been right on occasion, but they've been wrong a lot. They've been wrong over half the time when they made a one-year forecast, and almost 67% they've been wrong with they've been more than 20% wrong, if you will, when they're making two-year forecasts. So what that tells me is now I'm going to look at my forecasting calculators and I don't really know, what to think about what these analysts are expecting. Now, if I put a normal multiple on here of 54, which I think is extraordinarily high, I would look for a more reasonable multiple. Maybe I'll give it. Maybe this stock is going to continue to command a 35 multiple. And if it did, then, this would be interesting. But I'm asking a lot there. I want to make that clear. Is this stock really worth 35 times earnings? Keeping in mind that the current earnings yield on this stock is less than 3%. And I want to talk about that because I got a lot of comments in my last video about, new paradigm and all this stimulus spending and, it's going to change the valuations. We should have a new normal. Let me talk to you about earnings yield. Earnings yield is the amount of money that you're going to get back from the company if you got 100% of their earnings. Okay, so are you willing to invest your money and take great risk if you're only going to earn 2.77% on your money? Now, by the way, this company pays a dividend. The dividend is less than 1%. Here's the payout ratio down here. You're only getting a portion of the income in dividends. So, that's a pretty weak rate of return. Now, these higher valuations that existed here are market values. They're not intrinsic values. Intrinsic values are what you're going to see down here at the level of this orange line, not what the black line, the price line. So the market can, create sentiment and drive prices to all kinds of crazy levels, both up and down, by the way. And I've shown you some examples of massively undervalued stocks. But the point is, value is always a function of the amount of cash you get. And if you're getting 7% cash from a company, for example, as an investor, it doesn't matter what the discount rate is, doesn't matter what government stimulation is. It matters that you're getting 7 cents return on every dollar you invested. And so it really comes down to the pure growth potential of the company and how much cash flow that growth is going to generate on your behalf. Now, when you start paying outlandish valuations for that, you at least got to be cognizant of the fact that you're taking on enormous risk. That's really all I'm saying here. It may work out. Sometimes these stocks do work out. You may end up making these fabulous returns, double-digit returns on World Wrestling Entertainment if the company continues to trade at a high multiple in the 30s, if you will. But again, that's a big if. It has traded at higher multiples than that, but I also want to point out it's also traded at lower multiples than that. Okay, so you've got to make the decision for yourself. But anyway, when you're analyzing a company like this, you've got a lot of work to do. And I really believe you got a lot of work to do in terms of forecasting. What do you think this company is really capable of doing over the next 1, 2, 3, 4, 5 years and beyond? And are you able to buy it at a valuation that is prudent and compensates you for the risk you're taking? That's what value investing is all about. And price is what you pay, i.e. up here. Value is what you get, i.e. down here. And eventually price and value intersect, or they meet. They call that reversion to the mean statistically. Okay, and then last but not least, I want to go to Nexstar. Now, this is a very interesting company. I had not looked at this stock before, so I want to thank the subscriber that asked for it. But let's go real quickly to the company's website just to give you an idea of who they are. They're their largest local television and media company. They've got 198 full power stations, including partner stations. And you can see their numbers at a glance. 198 total stations, 120 local websites. They reach 62% of the U.S. household. They have 284 mobile apps, 4.3 plus billion in revenue, and 116 different television markets. So it's a very interesting entertainment company, and it's got really kind of an interesting history. Now, its earnings record has been moderately cyclical from one aspect, but it's also grown. Now, I've got another example here. This company lost money for almost this whole decade here, and it really started making money about 2012. So what I've got to start doing is shortening the time frames to come up with some meaningful growth numbers, and I'm still not getting it there. So let me cut off one more. Now I've got about a 14.9, we'll call it a 15% average, which means my 15 PE probably makes sense here. Now, but I've got a negative year added into that. So let's see what happens when I drop that negative year off. Now all of a sudden I've got 45% growth. I think what's important is the more recent growth that you're looking at, the more valid or relevant it would be to what you're examining. Now, the recent growth has been about 38%. Going forward, analysts are expecting a big number, or the company earned a big number last year. They're expecting a negative growth rate in 2021, followed by a very high growth rate going forward. But again, if I check alternate sources here, and there's many that I check. Morningstar, you can go to Standard & Poor's and get their data. Here we've got the next 5 years. They expect this company to grow at 57% on average. Next year, 48%. That's Reuters. Okay, so, we've got 42, 48 is close enough. The long-term 3 to 5 year trend line growth rate, we've got 56. The Reuters group got 57.4. So this now looks like a company that might be very, very interesting to look at. Now, once again, you can go back and look at with your FastGraph subscriber. You can look at all these other metrics. I always do, and I always recommend you do that. Clients often ask me, what's my favorite metric? And my answer is always all of them. I have them available. Why don't I use them? I can also go into things like fund graphs. And in fund graphs, I can look at a lot of other data when I'm examining a company. And again, I wouldn't invest unless I do. Now, here I'm looking at the income statement. I'm looking at revenue per share. Obviously, the revenues of this company have been growing very dramatically, but I'll also look at in millions data. And the other thing I see is this company's been issuing stock here, or they issued stock in 2017. They have made some acquisitions. That's something this company's been doing. So they've been raising capital. What I'd want to do with that is I'd want to measure how much capital they raised relative to the valuation they were paying to do it. But also, if I look at their total revenues, I can see that their total revenues have also grown. And more recently, if I shorten this time frame, their revenues have grown by at a very nice 30.5% rate. So this company is definitely a growth stock. There's absolutely no question about it from what I see going on in business. Now, I can look at returns on equity, returns on invested capital. I can look at, debt levels, cash flows to support that debt, etc. And I'm going to do all of that before I invest in the company. But here's the bottom line. What I'm suggesting is I'm going to take a look at this one myself. This company certainly, statistically, fundamentally, data-wise, looks like a company that ought to be examined closer, for, what its future might bring and what the risk. Now, it's only BB- rated, and it does have 75% debt. So there's some negative things to throw in there, but it's trading at 8.86 times earnings, has an earnings yield of 11%, almost double my minimum, a dividend yield of 1.5. And I do want you to notice that the dividend has been growing at a very nice rate. Now, I did see somewhere someone commented that the dividend on this stock is really irrelevant in an article and some research I was doing. I think that's, kind of ridiculous. This company is paid off a whole bunch of dividends. I think what the person was alluding to is their payout ratio has been, relatively low. And they haven't been, their yield is 1.85%. And, more recently, their payout ratio is, down to 12% last year and expected to be about 17% this year. But in reality, their dividend, because of the growth of this business, their dividend has actually grown beautifully. And you can see they've dramatically outperformed the market over this time frame. I did notice that the stock was down strong today, so it's something, you'd want to look at carefully. Anyway, this is the subscriber request for today. Some very interesting stocks that I've enjoyed kind of going through myself because I didn't know a whole lot about most of these stocks, as I mentioned earlier. But there's some fun stuff here to look at for those of you who are aggressive and looking for speculation. You might want to look at the Chinese names that I showed you, but again, be very careful, take into consideration the political risk there. As far as Worldwide Wrestling, trying to forecast what the growth of that stock might be is going to be challenging. By the way, the company suffered a little bit from COVID, but only about 2% of their business are the actual events. The majority of their business comes from their online and, videos and movies and things like that. So that's something to look at. Nexstar is a very, very interesting stock that you might want to consider for both growth and dividend growth. Anyway, it's been Chuck Harville saying thanks for watching. Hope you enjoyed this. I try to get a little deeper and talk a little more about how you can utilize FastGraphs to help you research stocks deeper and faster. If you like this video, give me a like, ring the bell, subscribe to the channel if you haven't already. As always, I appreciate you and enjoy it, and I'll look forward to talking to you again real soon. Thanks for watching.